Hello everyone and welcome to July's First Thursday Club. This month we're going to be hearing live from Singapore. Rob Charnock's going to be talking to us about navigating the shifting landscape of sustainability reporting requirements. Before I hand over to Rob, I'm just going to go through some housekeeping. I know a number of you have seen a few of these before, so you'll be familiar with this, but for those of you that aren't, we obviously mute everybody's microphones for obvious reasons. But we do want to hear from you. You can use the dialog box through this app to ask questions as Rob's talking. So please just put the questions in there. I'll be sifting those as Rob's talking, and at the end we'll have about 15 minutes to have a Q&A. So just please feel free to pop your questions in. After the presentation, we'll email out a questionnaire which helps us refine what we're doing and make sure that we're ticking all those boxes. And then what I'm going to do now is hand over to Rob, but before I do that, I'll just introduce him. Like I say, he's in Singapore at the moment. He's the director of RSK's Centre for Sustainability Excellence. He joined RSK after a decade of working as an impact-focused academic. He has a PhD in climate finance from the London School of Economics and has worked on sustainability disclosure projects for the UK regulators and international groups like the United Nations. Rob is currently part of the technical advisory group for the International Sustainability Standards Board and has been an active participant in the sustainability disclosure debate for many years. Today, he tells me, he's going to help us try and make sense of that debate to get a feel of where we are at the moment and where we see where things are heading in the next few years. So over to you, Rob.
Great, thank you very much, Tim, and it's great to be here with all of you today. As Tim mentioned, this has been a bit of a sort of, should we say, hobby project or perhaps obsession of mine for well over, gosh, I'd say about a decade now. And that really started around the time of my PhD. That was down at the LSE, working really on how to create standards to factor climate risk into the financial sector. So I've been part of the debate for a while, and I think one of the real issues that we have with that is, one of the issues we have in the debate is there's so much history to it and so much context that as soon as you hear a new acronym, it's incredibly hard to understand whether it matters or doesn't. So what I'm trying to do today is not necessarily give a long list of, dry list of this is one standard or the other, but instead trying to give you a bit more context so that when you do hear new acronyms, you can start piecing together which ones matter, which ones don't, which ones to pay attention to, and really how they're starting to coalesce, how they're starting to harmonize as well. Just briefly, as Tim's mentioned, I'm out in Singapore. I'm heading up RSK's Centre for Sustainability Excellence. I'll just very briefly comment on this. I won't spend long. One side of that is there's a research institute out here called METIS. That's very much drawing on my academic background, focused on anything to do with corporate climate action, auditing around that, and also the links to water. We also have a consultancy here which has a climate change team. Really anything to do with looking at the risks of climate change, the opportunities that might arise for your business are part of what they do. And there's much more to this as well. There's the carbon accounting side as well. But what they sit alongside is a team of digital water services. And digital water is very much about making sure that water infrastructure across Southeast Asia is gaining essentially a lot of the efficiencies that you can from slight tweaks to the infrastructure system, or also using data from around the world to help make better policy decisions. But as I promised, not too long on that, because really what I'm here to do is try to help navigate this world of sustainability disclosure. And in order to do that, I thought we'd probably start with the big news. And the big news is really, you've probably not heard of it, but it's the International Sustainability Standards Board, or the ISSB. And the reason I'd say this is the big news is not only because it's kind of just recently released 2 of their standards, but it's because of what ISSB represents. And really, it's an attempt to harmonise sustainability disclosures. So in that regard, it's not just another acronym adding to the many that are out there, but it's trying to take what has become seen as good practice from many of the other acronyms and create a common set of standards. And beyond that, it's not just a nice idea, they're backed by the accounting standard setters. So they're the ones that have rich, long history in creating the accounting standards for the whole world. And typically, the way their standards are used is by regulators who require compliance to the standards. In other words, to keep in a briefer version of that, is that these standards being produced by ISSB are likely going to be what regulators use in their mandating of sustainability disclosures. So that's why they're quite different, because this time it's much more about mandatory requirements or enabling regulators to make mandatory requirements rather than just being another voluntary initiative. So to dig into this a little bit more, like I've just said, it's linked to the accounting bodies. And in that sense, it's very much focused on what the compliance requirements will be, what the regulatory requirements will be. Because of that, it's not going to be the most advanced, it's not going to be the most progressive of the sustainability standards. Instead, it's more like a minimum baseline for the world. And so if you want to be ahead of the pack, if you want to be a leader in your industry, you might need to look to go beyond these. But really, this is about setting a minimum standard to create a level playing field so that everybody has the same requirements on disclosure. Now, this slide is not meant to be there to scare you, okay? This is a whole range of acronyms thrown in, but the idea is to show what ISSB is attempting to do. And we will go through a few of these because I do think it's quite important to understand what the different components are. And it helps me to explain a bit about the different styles of disclosure too. But really, ISSB is trying to make sense of this incredibly complicated space. Now, they're doing this in a few ways. One is they're using certain groups or certain frameworks as the input to the standards that they create. So essentially, they're not trying to reinvent the wheel. They're saying what works, what's already out there, and how can we use that to create our own standards. And then with a couple of the other groups, then they're making sure that they're aligned. They're making sure that they're interconnected, or at least they're compatible with the other groups as well. So it's really trying to make everything a lot simpler. So it's quite an exciting time that we've actually reached this stage after a few decades of work. I would say the next couple of years are where we're really going to see what regulators do with these. But if we dig into the ISSB to try to explain some of these different components, I think it's important if I just explain maybe, I think 5 of the other pieces on this slide to give you a feel for the ideas behind it and the different expectations that are being brought through. So I wanted to start with one that might be familiar to some people on the call because it's been around for a while. This is CDP. When it was launched a long time ago, it was the Carbon Disclosure Project, but they no longer use that name at all because they realized they had kind of shot themselves in the foot a bit by calling it carbon when there's much more that's required to disclose. Even on climate, you have to go much beyond that. So in that sense, they are now just CDP. And it's originally designed around carbon, as I say, and it was an annual questionnaire where they tried to gather up data from corporations around the world to become the main data gatherer on anything to do with climate from corporations. They've moved beyond that now. They've moved broader across sustainability risks and also nature-related topics too. And like you're going to notice a theme here. The theme is that any of these groups are very closely aligned or aware of the other reporting frameworks that are out there. They know what they do and they try not to interfere with the other groups. So for example, here, they're very much aligned and recognized by other reporting frameworks like TCFD and ISSB. And I'll talk about TCFD later. ISSB was on the previous slide. So in a nutshell, though, CDP has this annual questionnaire where corporates provide their information, and those responses to the questionnaire are ranked. So you actually get a ranking as a company, and there's expectations that over time you also show progress as well, and the rankings reflect progress that's being made too. So there's a degree of expectation to do it reasonably well. The next group has a slightly different approach. So they're less focused on sort of questionnaire that's about carbon data originally and now a few other things, but instead SASB, as it's called, or the Sustainability Accounting Standards Board, was much more focused from day one about, if you look at the whole sustainability agenda, which are the issues that are material to your business. It was very much focused on what will investors in your business be most interested in. So it's not everything about sustainability, it's which sustainability issues are most material to your company. So it's slightly broader in that regard, and also they don't have a questionnaire as such. It's more, you can comply with these standards, you can ignore them potentially, it depends on a lot of factors. Now, what I should say about SASB is it very much was from North America, from the United States. So a lot of the standards have that leaning. towards that, but they're in the process now of changing quite substantially because SASB is one of the really key inputs to the International Sustainability Standards Board, the ISSB. So we've just on a quarterly call recently, and they're explaining how certain requirements are now trying to be made globally relevant instead of very US specific, which has a whole range of issues, but they're doing it, they're working on it, and they'll get there quite soon. So again, the focus here, decision useful information for companies and investors by focusing on the material issues. And I think that's quite important for you to focus on with navigating this space. There's an increasing focus on what is material. How do you identify what is material? What were the processes you used to decide on the material issues as well? The next group that's connected with ISSB is integrated reporting. Now, IR, or integrated reporting, had quite a different approach, and the core of their approach was really saying, what are the different types of capital that your business requires in order to generate value? So it's not just looking at the impacts of your business, but really trying to get businesses to consider more, what are the different relationships, capitals, and so on that we require in order to do what we do, in order to create the value that we have. And it's not only financial, and it's not only environmental either. There's manufactured and intellectual human capital too. But natural capital is a key part of this, as well as I mentioned, the social and the relationships. So in this regard, it's much more about trying to change the way that you look at your company and what enables your company to operate beyond the financial. It is important to the ISSB. SASB has had much more influence from what I've seen over how ISSB looks, but integrated reporting is definitely there, and it's something to be aware of, I would say. Creating an integrated report was a fad at one point. There's other things now that have come to the foreground as more important, but still, it remains quite influential. And this is another one that a few people may have heard of in the room. It's GRI for short, or the Global Reporting Initiative. And GRI has a slightly different take. They're not a sort of core standard. They're not asking you to fundamentally revisit how your business creates value. Instead, GRI tries to take the whole sustainability agenda and look at what you can disclose on those issues. But it's not saying that you have to look at everything. Instead, it's more of a modular system, a slight pick and mix. And there's ways that you can pick and mix to make sure you comply with certain regimes. But essentially, their modular approach is much more helping companies to focus on the issues that they think matter most and produce relevant reporting on those specific issues as well. So in that regard, I think this is, if you're going to produce a report based on GRI, you can do it to make it more or less compliant with quite a few other disclosure regimes too. So it's quite clever because of its modular approach, and it's definitely widely regarded as quite influential. Here in Southeast Asia, it's one of the most widely adopted approaches to corporate disclosure, and we'll see how that evolves as ISSB does as well. But like I say, ISSB and GRI are very much aware that they need to complement each other. They're not competing for the same space. They're aware of what one another do. They inform one another of any changes. They sit on one another's steering groups and so on. So ISSB and GRI are very closely connected. Now, the one I've left until last here is the Task Force on Climate-Related Financial Disclosures, TCFD. And I've left it until last for a few reasons. And one of the main ones is it's quite a different approach to disclosure. If you think about carbon footprints, for example, that's very much giving a snapshot in time of the emissions from your company, and maybe gives that view of the last year or the recent history of your company. And over time, that's an incredibly useful data set to have, to look at the trends, to disclose your true impact. So it's not to say carbon footprints aren't relevant, but it's to say there's another piece that you can also look at, which is more of the forward-looking piece, more about the strategy, more about the risks that your business faces. So if you think about carbon accounting and carbon footprints as an incredibly useful view of the impacts of your business at a point in time, TCFD requirements are more about how well is your organization geared to navigate the future. And it's premised on this idea that we know the future is going to be different as a consequence of climate change. We just don't know exactly what it's going to look like, because we don't know if we're going to tackle the issue. And if we do tackle the issue, it brings certain risks because industries will change dramatically. If we don't tackle the issue, it brings risks because climate change will be worse. And the physical impacts will be much more profound. So the way TCFD approaches this is it's very much a framework for taking a systematic look at your internal processes within your business, your governance, your strategy, your risk management, and your metrics and targets that you use. So those are the sort of key focal points. And this was launched around the time of the Paris Agreement in 2015. And really what it was trying to do at the start was help businesses understand the risks that they face from climate change. And it did that quite effectively for its first few years and really built up its ability to help companies think about climate risk, give frameworks for doing that, frameworks for how to disclose as well. So it really focused on the risk component to begin with. And then it started moving much more towards, okay, but what about strategy? Strategy was this missing piece that people hadn't grappled with. And right now, strategy is more of the focus for the area of development. So strategy is where we're going to see TCFD change in the next few years. There'll be stronger requirements. And one of those is going to move towards transition planning. I won't complicate things now by saying that, except to say that the ISSB also have included transition planning as part of their climate standard. So again, it comes back to this point. These different groups are aware of one another. They try to already harmonize to an extent, but the ISSB is now a critical focal point for bringing together what is now seen as common good practice, so that you can look at the ISSB standards and understand how to get the basics absolutely right and probably do what the regulators are asking you to do, because the ISSB standards will be influential in that way. So just to come back to this slide, that's been a whistle-stop tour of 5 of the groups that have been quite influential, very influential in this space. It's by no means exhaustive. I could go on for hours here, but I won't, I promise. But it's really coming back to this point that the ISSB is we're at a really critical moment in history, where hopefully this is going to become a lot simpler, because you can just look at their standards. Your regulator will require you to look at those standards as well and comply with those. But equally, I wanted to make sure you had that broader context of why it's so important, because it harmonizes not just 1 or 2 of these things, but quite a few different approaches. And at the same time, if you want to go a step further, hopefully what I've said helps you say whether TCFD is more relevant to you because you're thinking about risk and strategy more than anything, or whether actually you need to look at CDP to get that more of the annual questionnaire disclosing the information that's required. Hopefully it just helps you navigate a little bit. But again, the core story is that ISSB has launched its first 2 standards. There'll be 2 more standards. I think they're on track to publish those next year. They're currently doing a lot of the research and a lot of the foundations for it. They're likely going to look at something connected to biodiversity and something connected to social issues, human capital and human rights, perhaps in their 4th standard, but it's a bit early to say. So far, they have a core standard, S1, which is a general standard, and S2, which is the climate-related standard. But they'll continue developing these, and the demand for it seems to be quite strong. But I realize what I've said so far could be, I don't know, maybe a little bit high level, because it's just talking about the framework. So I also thought it was useful to zoom in on the UK. Now, at the end of this slide deck, I also have other sections on Europe and on the US. We won't have time to cover, but my email address is at the end of the slide deck. So if you want the full deck, just drop me an email. I'll be happy to send the full slide deck over to you. So if we look at the UK specifically, I wanted to stay with TCFD just for a bit longer, because it's easy to think that just because it has climate in the name, it's about environmental dimensions of ESG. Whereas really a big part of what they're trying to do is also get the governance in order, your internal processes, make sure that they are well equipped, obviously to deal with climate change, but that's much more, if you have those systems in place, they're much more readily adapted to a lot of the other issues in sustainability too. So things like building a cross-functional working group, that's a really, maybe that sounds obvious, but it's a real step change, because it used to be that a lot of this reporting work could be done through the sustainability function of a business. But because TCFD is talking about risk, governance, strategy, it requires oversight from the board. It requires sign-off from the board, frankly, when climate change is recognized as a material risk and a key risk on the risk register. So in that sense, it requires input from across the entire company. Now, it requires effective leaders as well, who command a degree of authority across the company and who are empowered to do that because the board have given the resources and the board have backed it with a message to say, this matters, we have to take it seriously. Even if it's not because it's just the right thing to do, it's because the regulators are increasingly talking about this and expecting companies to disclose. And some of you, RSK, for example, is already well underway with TCFD, partly because it was the right thing to do, but also the regulators making it very clear what the expectations are. There's a link on this slide to some of the technical dimensions of TCFD. That's a research project I ran a couple of years ago for the UK's Financial Reporting Council. So it's just an example of the types of research the regulators do to understand these frameworks and design more effective regulations as well. But again, that's for people who really want to deep dive on TCFD, so it's probably not for everybody, but still. Now, to talk more about the regulatory world, the regulatory movements in this space, the Financial Conduct Authority have made a big move towards TCFD reporting requirements. It applies to UK listed companies. TCFD is also going to be applying to large companies as well. And it's increasingly being made mandatory in different jurisdictions. So for example, in Singapore's rolling it out on a few industries each year, but still it's happening already. So the jurisdictions around the world are seeing TCFD as one of the upcoming regulatory requirements, broadly speaking. Now, I think the idea behind this, though, and this is what I want to come back to, is the reason they're requiring this is not just because they've suddenly become eco-warriors within the Financial Conduct Authority, surprise, surprise, but instead it's much more about saying they think they need to help create more information about climate-related risks. So the regulators believe that there are material risks resulting from climate change that businesses have not identified. And that makes the regulator very worried about the stability of financial markets, the stability of industries, because it's overlooking a risk that faces the whole of the economy. So they're doing this because they're convinced that climate change risks are being overlooked. And so therefore they're requiring companies to take a much closer look at how climate change will impact their operations, impact their assets, impact their clients going forward as well, and also their strategy for the coming decades too. So in that regard, it's not that the regulators have discovered sustainability and have made that their core remit. Their core remit has not changed at all. They've just realized that climate change is now an increasingly important part of achieving their remit of, for example, stability in the markets. So this is again about creating the information that the regulators think is required. Now, it's not just about TCFD, of course. I've been looking at TCFD for a couple of years, so I tend to be a bit biased in that regard, but there's also disclosure requirements more connected to carbon accounting and carbon footprints. So here's where you're talking about scopes 1, 2, and 3 greenhouse gas emissions. I won't get into those here because I don't want to get too deep into any one aspect of this. It's meant to be a broader view, I would say. But even so, it's what you can find with these is very good summaries online of which companies they apply to, and of course all of those are published by the regulators as well in a slightly different language, but still it's clear enough once you've spent a long time trying to understand it, I'm sure. But again, the point I'm coming back to is the direction of travel here is that the regulators are now taking climate change seriously. Biodiversity is on their radar, and inequality and more broadly the S of ESG is coming up quite quickly behind that. So at the moment, climate change, biodiversity, inequality seem to be the three focal points on the radar for regulators, and where there's going to be most movement in terms of mandatory requirements and which standards you need to comply with. And again, it's likely going to be connected to ISSB at the end of the day. There is also something else on this very same topic, which is why are there now so many task forces? So if you see all the acronyms that are out there, you might have spotted that there are certain ones that start looking familiar. So for example, the Task Force on Nature-Related Financial Disclosures. Well, this is TNFD instead of TCFD because it's nature-related, not climate-related. But again, it's adopted a similar framework to TCFD because they saw TCFD gain traction. They saw that the regulators liked the approach that was being taken. It was developed with the backing of regulators too, particularly through the Bank of England support for it. Now, So TNFD is trying to take a similar approach, again, focusing on nature-related risks, but also the opportunities produced by this. A lot of the techniques are very similar. They use the same pillars around governance, strategy, risk, metrics, and targets as well. So in that regard, it should look somewhat familiar. And again, a lot of what the focus is on here is about collaboration. So not only engaging with the right external stakeholders, but also the right internal stakeholders. And this is one of the hardest things companies find, is identifying the right people from across the business to bring together to really make sense of things like climate change or biodiversity loss. So again, this is about enabling the board of the business to understand impacts, to get the information they require to make the right decisions. And that's where the regulators see these disclosures as being most important. And there's more task forces, you'll be pleased to hear, I'm sure. And 2 task forces that were set up to try to do very similar things. One was the task force on inequality-related financial disclosures, and the second on task force on social-related financial disclosures. Now, I think they realized there was a bit of overlap, to say the least, and they're now consolidating their efforts into a single one. I'm sure it will be a task force. I just don't know what the acronym is going to be yet for that one. But the shared vision, again, is really this global framework for financial disclosures linked to both social and inequality-related risks. There's a huge amount of work to go into helping companies understand what those risks might be and how they might be transmitted through to the bottom line. But at the same time, that's why they're using a similar framework to TCFD, because it's become familiar to businesses that have had to adopt it. And so as it's rolled out, it leverages those same processes that have already been put in place. So again, hopefully it becomes a bit easier, because once you've established a cross-functional working group for TCFD, hopefully it's a very similar group that you need for TNFD when that comes around too. So again, it's this idea of once those processes, the systems are in place, leverage those instead of requiring companies to create entirely new, everything from scratch. There'll be new parts for everything. And a brief comment that if inequality and social related risks are particularly relevant to you, then there's a lot out there, but one of the key touch points that keeps coming up is the United Nations Guiding Principles on Human Rights and Business. So this is just to flag it in case the social dimension is particularly relevant for anybody attending today. I won't go into a huge amount of detail, because what I want to do here is look ahead as well, because hopefully that's been useful to provide some context to where we are and what matters to you. But also I think this space moves so quickly, I want to talk about where we're going. Now, I'm sure a lot of you will have heard the term ESG, environmental, social, and governance, but it's not as though it's very well defined of the entirety of what ESG is. Instead, what you tend to find is that certain issues will gain the limelight in a particular year. So we've had climate change really dominate a lot of the ESG debate for the last couple of years. Biodiversity is increasingly coming up, as well as inequality. So what you find is any one point in time, there'll be a new focus in the ESG debate. And that tends to be what a year or maybe 2 years later starts coming through as regulatory requirements as well. So because of that, I think what we're likely to see is this approach adopted by TCFD and now TNFD. It seems very much here to stay. It's definitely being embodied in the ISSB standards as well. So that seems pretty well set. And so those approaches will continue to mature. One particularly tricky technique, and that is climate scenario analysis. That's received a lot of attention. It's matured a lot. There's still more to do. But right behind that, we're now hearing conversations about biodiversity scenario analysis as well, which requires a lot more work because it's in its infancy. I mentioned much earlier that strategy is a key area of focus for TCFD, and so this is why climate or net zero transition plans are really receiving a lot of attention. In the UK, there's the Transition Plan Task Force, and I can tell you from sat here in Singapore, that's received attention from at least this part of the world, looking at what transition planning looks like. And finally, the question of how to audit this, the assurance required on ESG, is a huge topic in terms of the reliability of the information. So ESG assurance, ESG audits is receiving a huge amount of interest, and the ISSB standards should be an incredibly useful foundation for auditing of this information going forward. So there's I'm sure there's a tone of optimism in what I've said, partly because ISSB is laying the foundations for fixing a lot of issues, including how confusing the space is, but also including things like how do we audit this information. There's a few other things as well. I think the momentum behind biodiversity is for very good reason, not only because of the science about it and the risk it poses to society and economies, also through the very well-established frameworks that are in place. You have a whole United Nations process that's been going on for a long time, TNFD, really formalizing how businesses can grapple with this, and also quite clear guidance on how to set targets for your nature-related aims and objectives. We were definitely going to see more harmonization. The ISSB is driving that. But what I notice is it's not only that ISSB drives it, but with ISSB existing, the other groups realize that they need to start tweaking their own standards to make them more relevant and interoperable with ISSB. So everything is becoming much easier to navigate between all these different groups. You may have seen the efforts in the US in particular to politicize the ESG debate. So there's it's interesting to see what happens there and see if that spreads and whether ESG falls into the backdrop and it becomes more of a pressure driven by regulators rather than broader public debate. But I would say the final point here is just the regulatory pressure, the regulatory requirements for this are huge. Obviously that comes through the regulators and mandatory requirements, but also there's still the voluntary initiatives out there. And even though they're voluntary, sometimes they're kind of the de facto for the industry, and they're pretty much expected, even if the regulator hasn't asked for them yet. And I'm sure you found that in a few areas already. So this has really been a whistle-stop tour of a few of the key things. There's quite a few that I didn't talk about, so do feel free to ask me questions on a huge range of other topics, and I hope I can answer them. But also, if you want the slide deck, or if you just want to pick my brain on something very specific that was mentioned, if you ask a question now, but also reach out afterwards. My email address is here. I'm also on LinkedIn, so feel free to drop me a message, connect on LinkedIn. But yeah, that's everything. So I look forward to the questions and the discussion. And Tim, I'll hand back to you.
Thank you very much, Rob. Really, really interesting and a really useful walk through what is a very complicated landscape. And although looking like there may be signs of a sort of a coalescence of things to make it less complicated. We have, I suppose I should also say thanks for staying up so late for this, by the way, or staying in work for so late. We have a couple of questions. We have here somebody saying that, so if I've understood correctly, the accounting standard setters are now deciding that they need to play a role in simplifying sustainability reporting. Why didn't they do that 10 years ago, and what's changed?
Yeah, okay. I mean, I should admit now. I'll admit now, my PhD is technically in accounting. Okay, so this is a geek topic for me for sure. They're always very cautious, the accounting standard setters. So they watch the space very closely. They weren't convinced it was their role to take a major stance on sustainability. I think what changed is in 2015, the Bank of England started really talking about climate risk as a major threat to the economy, having something that can't be ignored any longer. And for accounting standard setters, when one of the large central banks starts saying that, and I should say Banque de France as well, Central Bank of France had a huge role to play. That's when the accounting standard setters realized we probably need to start thinking about how we operate in this space. So it was still a long time coming, but that's where ISSB has finally come in. It's probably come at the right time because there's a bit of cohesion around what good practice looks like and what we should do going forward. So it's just that nervousness of knowing whether it was their space or not. It would have been great if they came earlier because it would have avoided this proliferation of acronyms. But even so, I think the proliferation of acronyms has come up with some quite useful practices. So it's not all bad.
Okay, on the topic of proliferation of acronyms, I'm going to have to read a few out for this question, so bear with me. It says, you talk about TCFD, TNFD, TIFD, TSFD, etc. Thanks for putting in the etc. at that point. Is the intention that ISSB will eventually supersede these at some point, or will the ISSB act as a complementary framework to cover different aspects of the task forces?
That's a good question. I would, a very quick answer, I would be very surprised if ISSB supersedes these. And the reason for that is ISSB is trying to establish a global minimum standard for sustainability disclosures. So it's not trying to be particularly exploratory or advanced or adventurous. It's trying to say, what are the core components to doing this well? And as a result, I think ISSB is more going to watch what other groups do, and it might tweak its own standards to adopt new things that seem quite useful. So I would imagine that there will still be a lot of other groups. And if you want to be a leading business in your industry, you're going to have to know what the latest recommendations from TCFD and TNFD are, because they might not be reflected by ISSB. So I think ISSB will evolve over time, but the way it will evolve is because these other acronyms have come up with even better practice that's become recognized as something that should be adopted, and ISSB say, fine, that is now a new part of the global minimum standard. So I don't think supersede is quite right. I think what it helps do is create a level playing field across industry. So it's not just the 15, 20% of businesses that are trying to be at the forefront. Instead, it's the rest that also have to start doing this as well.
Okay, fair enough. I think that probably this is a linked question, and you probably sort of partially answered it there, but the question is, to what extent is the ISSB building biodiversity into their standards?
Yes, they are having a lot, they're putting a lot of resources this year into research into biodiversity and ecology, because they want to understand how to build it into their standards. What people are saying is that the third standard, S3, will be focused on biodiversity. ISSB haven't really said that. They've said that they're paying a lot of attention to biodiversity because it's a hot topic, but at the moment they're probably doing about another 6 months of research to really understand the issues. And on that note, since I'm on their panel, I should probably say there is an open consultation. If you have particularly strong views on biodiversity and would like to let the ISSB know, they have a consultation that's open until the 1st of September. So please, they are very, very keen to hear from people, not just management consultancies, but also people with deep expertise in biodiversity, because they really want to get the scientists essentially involved in making sure these standards are right. So if you have strong opinions, please make them heard in the next 10 weeks to ISSB. They've got a very simple survey to do it. You don't have to draft a whole letter if you don't want to.
That's a very good point, and I think, yeah, for a lot of people in the audience today, there's going to be a lot of expertise there, especially in the biodiversity area, I would have thought. So yeah, that's a good point. Another question then, do you see the regulators such as the Finance Conduct Authority requiring TNFD aligned disclosures? And if so, when might this happen?
I can definitely see it. I haven't had conversations with them, so this isn't giving anything away about this, but yes, I know regulators are watching TNFD very closely. They are upskilling, I would say, on biodiversity. They did the same thing with climate change. The regulators had to learn this stuff too at one point, and at the moment learning a lot about biodiversity. So yes, I can very much see TNFD being built in. I think the thing that would accelerate that is if the idea of biodiversity risk gains traction in the financial sector. I think that would accelerate it quite substantially if that does happen. I think if that doesn't happen, though, there's still enough momentum and enough to borrow from with the TCFD process that it could come through. So you might start hearing things soon, depending on what happens. I don't know what the time frame looks like, but it won't be 10 years. It will be much sooner than that people start looking much more closely at TNFD.
So do you think that the people like the FCA would recognise, biodiversity loss or ecosystem collapse as a material risk, and that they would then require companies to disclose that as a material risk?
Yeah, and the reason I say this is because if you look at a lot of the research groups, or particularly commentators who drove the climate risk debate, these were people who'd been in the finance world for 3 decades. These weren't eco-warriors who put on suits, if you like. And so they very much looked at the scientific plus economic analysis of climate change and said, we're missing something huge for the industry. And those same groups and people have turned their attention to biodiversity and are saying very similar things about the collapse that's underway and the impact that's going to have on every single aspect of business. And frankly, the argument with TNFD is the end, the nature is much bigger than climate. So frankly, TCFD should probably become part of that too. But yeah, from what I'm seeing, the notion of biodiversity risk has enough backing, enough strong analysis that it's gaining a good foothold with the regulators. It's a key concern.
think we've probably got time for a couple more questions. This one says that you emphasise the distinction between carbon accounting and the types of reporting we now see on climate risks and opportunities. What does this mean for companies that are trying to wrap their head around the disclosure requirements, and what are the implications for them?
Yeah, okay.
Quite a lot in that.
I think I think what it means for companies is if you're more focused on the carbon footprinting, it's much more a sort of it's a very challenging data exercise in order to report where you've got to as a company. If on the other hand you're grappling with risks and strategy, carbon footprinting requires input from across the whole business, of course, but with the risk and strategy discussions, it's often going to board level. It often needs to get sign off from a lot of other division heads as well. So I would say anything to do with risk and strategy is much more about working across multiple functions in the company, identifying the key people to bring in, both because they know about the issue, but more importantly, in a way, you need to have a couple of people who know about the issue, but you really need a lot of people who know the different parts of the business, because it's about connecting the issue to the business as a whole. So I think, to me, if you're trying to look at TCFD and risk and strategy, it's assembling that group of relevant people from across the company, not just people who care about the issue, but really people who understand the business really well. And that's a slightly different requirement from the more data collection focus in, say, carbon footprint side of the standards.
Okay, I think we'll have one more question. By the way, I should say that you can add in questions here. What we'll do, the people we haven't got around to asking the questions to Rob, he will respond to the questions via email. So he'll get a copy of all the questions and get back to everybody. So the final question then, you talked us through a lot of frameworks, but one group you didn't mention is the Science Based Targets Initiative. Why was that?
I'm glad only one was listed.
Okay.
Yeah, I think it's because, yes, and there's not a judgment call to say they're not relevant. It's hugely relevant in a really impressive framework that's been built. I would say it's probably more because I wanted to focus on disclosures, and science-based targets are recognized as a really valuable input in how you produce disclosures around targets in particular, potentially linked to strategy too. But in terms of disclosure requirements, it's more a really useful method for what's required by regulators, and that's where I wanted to focus. It does have its own recommendations of what you should disclose, but in terms of what's really critical from regulatory point of view, yeah, I think it's that it is one key method to doing that well, but it's not necessarily giving you the full framework that regulators are interested in.
Okay, thank you very much. And thanks again, Rob, for staying at work late to do this. It's been really fascinating. Thank you.
My pleasure.
As Rob said at the end there, he's happy to share the slide deck. We won't just send it out blindly to everybody that's registered, but if you want a copy of it, he will send that through to you via email, and his contact details were up before. I'm just going to wrap it up. We've got a First Thursday Club next month on the 3rd of August. And we're going to be joined by our colleagues from BINIS, which is an RSK group company, and they're going to be talking about technology for ecology surveys. Just a last reminder that we'll be sending out a questionnaire after this, so we'd be really appreciative if you could fill that in and get back to us. And apart from that, I will see you all next month. Thank you.
Thank you, everyone.